As 2024 draws to a close, troubling news about China's economy continues to surface. Chinese leader Xi Jinping is once again set to face Donald Trump, the incoming U.S. president, in what promises to be another high-stakes showdown. Even before the drama officially begins, tensions on the U.S. China economic front are running high. Data from China's State Administration of Foreign Exchange, SAFE, shows that after Trump won the presidential election in early November, capital outflows from China hit $45.7 billion in November alone, a record for a single month. Official figures tracking cross-border investments in stocks and bonds reveal that China's November cross-border investment income was $188.9 billion, while payments totaled $234.6 billion, leaving a $45.7 billion deficit, the largest monthly deficit ever recorded for this category. This means that domestic Chinese banks, acting on behalf of their clients, sent a net total of $45.7 billion overseas in November, primarily for securities investments. This includes funds used by foreign investors exiting China, as well as local residents purchasing overseas securities. SAFE's data aligns with other trends in China's capital markets. In December, China's central bank reported that foreign institutions sold offshore corporate bonds for the third consecutive month in November. Goldman Sachs also observed a sharp increase in November's forex outflows, estimated at $39 billion, up significantly from $5 billion in October. The firm noted that much of this outflow occurred through cross-border transactions involving the yuan, likely through asset investment platforms facilitating yuan-based transactions. Reuters highlighted that the Stock Connect program, which allows foreign investors to buy mainland Chinese stocks using the yuan, plays a major role in cross-border flows. These transactions are conducted in Hong Kong, and while China no longer discloses daily foreign investment data for this program, the overall trends are reflected in SAFE's cross-border investment data. Analysts believe that Trump's proposed tariff policies and the widening gap in returns between U.S. and Chinese securities are driving these capital outflows. During his first term, Trump launched a fierce trade war with China. During this year's campaign, he promised voters that if re-elected, he would impose tariffs exceeding 60% on Chinese goods and revoke China's most favored nation trade status. Although Biden maintained Trump's tariffs on Chinese imports during his term, Trump went even further in his campaign rhetoric. He warned that if China attacked Taiwan, the U.S. would respond with tariffs of 100% to 200% on Chinese goods. Trump also declared that any Chinese aggression toward Taiwan would result in bombing Beijing. Trump has also issued a stark warning to BRICS nations, cautioning them against moving away from the U.S. dollar. He stated that any attempt to replace the dollar in international trade would be met with 100% tariffs. The BRICS nations, initially formed through meetings between Russia, India, and China, later expanded to include Brazil, South Africa, Egypt, Ethiopia, Iran, and the UAE. Under China's influence, the group has heavily promoted de-dollarization initiatives. As Reuters reports, while China's capital outflows hit record levels, its stock market rally, driven by policy support since late September, has lost momentum. Simultaneously, the yuan has continued to weaken against the dollar, particularly under the looming threat of Trump's proposed tariff hikes. The report highlights that China's capital outflows reached $25.8 billion in October alone, and the growing deficit in November underscores a severe lack of investor confidence in China's markets. Bloomberg attributes this vicious cycle of outflows to several factors: Trump's tariff threats, the yuan's depreciation, weakening stock market performance, and the widening gap in interest rates between China and the U.S. The Institute of International Finance also observed significant capital outflows from China's stock and bond markets in November. It noted that the strengthening U.S. dollar following Trump's election victory has driven away capital from emerging markets like China. Ken Chung, chief China FX strategy at Mizuho Bank, commented, "If currency depreciation served as a tactic to counter the tariff shock, the likely escalating trade war could reinforce U.S. dollar exceptionalism and weigh on regional currencies." The rising trend of capital outflows reflects worsening sentiment towards China's economy. Since late September 2024, Beijing has introduced measures to address the real estate crisis, stimulate consumption, and combat deflation. However, these efforts have yielded little success. Failing to meet market expectations, China's stock market lost steam in October. Benchmark sovereign bonds yields now stand at less than half of those of U.S. Treasury bonds. Meanwhile, the yuan's onshore exchange rate hovers near a one-year low, and the dollar index is at its highest since 2022. Recently, the Chinese government held its 2024 Central Economic Work Conference in Beijing. While the meeting announced plans to increase the fiscal deficit, issue more bonds, and adopt loose monetary policies to encourage spending, no major new policy initiatives were introduced. As a result, both mainland and Hong Kong stock markets have plummeted, with netizens lamenting the huge losses suffered by investors. November economic data paints a grim picture. Consumer spending fell far short of expectations. Real estate and foreign investment continued their sharp declines. Private investment remained weak, and the Producer Price Index marked its 26th consecutive month of decline. These trends suggest that Beijing's economic stimulus measures since September have had minimal impact, leaving the economy in a prolonged slump. Data from the National Bureau of Statistics shows that retail sales of consumer goods grew by just 3% in November, the lowest rate in 3 months and well below the forecasted 4.6%. This also fell short of the average 3.3% growth seen in the first 3 quarters of the year. The struggling real estate market, critical to restoring consumer confidence, continues to weigh heavily on the broader economy. In the first 11 months of 2024, China's real estate investment dropped by 10.4% year-on-year. The sales area of newly constructed commercial properties fell by 14.3%, while sales revenue decreased by 19.2%. Additionally, the inventory of unsold commercial properties grew by 12.1%. New housing starts declined by 23%, and completed construction fell by 26.2%. Julian Evans Pritchard, head of China economics at Capital Economics, noted in a December 16 report to clients that these disappointing figures highlight the challenges policymakers face in achieving sustained economic recovery. Foreign direct investment, FDI, in China, measured in yuan, dropped by 27.9% from January to November 2024. This decline doesn't even account for the yuan's recent depreciation. U.S. economist Davy J. Huang believes this reflects cautious and pessimistic attitudes towards China's economic prospects. It also shows that China faces significant challenges in attracting foreign investment, despite implementing policies to appear more open to global investors. The continued drop in FDI suggests that tensions in China's trade and economic relations with developed Western nations have not improved. Huang further argues that China's future economic growth looks weak. Without fundamental improvements in international relations, particularly with the U.S. and Europe, China will continue to face substantial pressure. The Wall Street Journal echoed these sentiments, stating that China's economy is losing momentum. Many economists predict slower growth next year, especially if Trump implements his promised high tariffs on Chinese imports. Since the pandemic, China's leadership has adopted conservative stimulus measures, aiming to shift the economy away from real estate dependency toward new growth factors. However, emerging industries like electric vehicles have yet to offset the shrinking real estate sector. The Chinese government recently hinted at plans to substantially increase long-term special bonds next year to promote consumption and support industrial upgrades, such as programs to replace old consumer goods. However, Bloomberg argues that these measures may fall short of stopping the spiral of deflation or saving the struggling real estate market. In 2008, during the global financial crisis, China launched a 4 trillion yuan stimulus, which helped stabilize the economy but left behind massive debt and overcapacity. Today, such an approach is unlikely to yield the same results. The population dividend has diminished, and local governments, businesses, and residents are burdened with significant debt. Overcapacity extends beyond infrastructure to various industries, leading to investment waste, relentless competition, and price wars. In a December 9 meeting, the Chinese Communist Party's Politburo used unprecedented terms like stronger, forceful, and extraordinary to describe their approach to tackling economic challenges. For the first time in nearly 14 years, they also signaled a return to moderately loose monetary policy. However, experts believe China's monetary easing policies are still insufficient. Professor Siming Fong from Tamkang University in Taiwan explained that countries with well-functioning market mechanisms see better results from monetary or fiscal stimulus because businesses remain local. When the government boosts the economy, companies can recover and regain vitality as conditions improve. China's current problem, however, lies in the ongoing shift of global supply chains away from the country. According to Siming Fong, as global supply chains continue to shift away from China, many high-quality manufacturers are forced to leave. Those remaining in China are often less competitive. In such a scenario, even if the Chinese government implements more stimulus measures, it may only extend the survival of these struggling businesses or ease their loan burdens. However, this would also increase the risk of bad debt for banks. Experts broadly agree that the unpredictability of Trump makes it difficult for Beijing to anticipate what kind of concrete plan he might implement once in office. Much will depend on the specific policies of his administration. Since Trump's election, the uncertainty surrounding the U.S. China trade war has unsettled Chinese leaders. Zhao Tong, a senior fellow at the Carnegie Endowment for International Peace, stated that Beijing is particularly wary of a potential resurgence of a trade war under Trump, especially as China is grappling with significant domestic economic challenges. Zhao also highlighted Beijing's concerns about Trump accelerating the decoupling of technology and supply chains from China. Such moves could threaten China's economic growth and indirectly undermine its social and political stability. Xu Jinping, president of the New Paradigm Foundation in Hong Kong, noted that Trump tends to prioritize practical interests, aiming to bring back industries critical to economic growth, jobs, and tax revenue. When Trump returns to power, his focus on pressuring China is likely to center on economic and trade measures such as tariffs. However, the specifics and intensities of his policies remain hard to predict. Lai Rongwei of the Taiwan Inspiration Association predicted that 2025 could see an increase in black swan events for China, with Trump's actions against Beijing potentially becoming the most significant and impactful. By definition, black swan events are rare and unpredictable occurrences that have major consequences, often triggering a chain of negative reactions. Chinese affairs expert Wang He reflected that China's economy was already in dire straits in 2023. Many had hoped that 2024 would bring significant policy changes to revitalize the economy, but Beijing has shown little ability to act effectively. According to Wang, foreign investments have been fluctuating because investors no longer trust the Chinese government's ability to revive the economy. Wang attributes Beijing's lack of policy flexibility to two key factors. First, its confrontational stance toward the U.S., which is set to intensify with Trump's return, including the possible elimination of China's most favored nation trade status. Second, Xi Jinping's domestic policies lean heavily toward state control while stifling the private sector, leaving little room for entrepreneurial growth. Wang concluded that China's economic struggles are a direct result of rigid ideology and policies. Trump's return to power could have widespread implications for China, potentially derailing some of Xi Jinping's key projects initiated in recent years. On December 17th, Xi personally visited Sanya in Hainan province to urge local officials to expedite the implementation of core policies for the Hainan Free Trade Port. He emphasized ensuring smooth operations after its planned closure for customs purposes. This rare personal intervention suggests that local officials might be unmotivated, perhaps due to doubts about the port's prospects, forcing to apply pressure in person. The Hainan Free Trade Port, initiated by Xi Jinping in 2018, aims to turn the entire island into a free trade zone with zero tariffs, slated to officially begin operations by 2025. However, official data suggests that the prospects for the project are far from optimistic. From January to September this year, while the number of newly established foreign invested companies grew by 10% year-on-year, actual foreign investment utilization dropped by about 20%. In October 2024, Chi Fulin, an advisor to the provincial government, remarked that challenges facing the free trade port outweigh the opportunities. He highlighted the limited appeal of Hainan's policies to American and European investors. For example, in 2022, the UK invested $350 million in Hainan, while U.S. investments amounted to a mere $53,000. While actual foreign investment grew steadily between 2018 and 2024, 2022, it declined by 12.1% in 2023. Xi also pointed to the slow implementation of free trade port policies, which has undermined the confidence of both domestic and international investors. Business sentiment remains weak, as evidenced by the fact that while 1.74 million new market entities were registered in Hainan in 2023, 350,000 were deregistered. A rare admission came when Xi hinted that China's national security policies are hindering the development of the free trade port. Under the government's focus on balancing development and security, policy implementation in Hainan has become increasingly difficult. In the Chinese Communist Party's 20th Central Committee plenary session decision, the word security appeared 44 times. Strict regulations have reduced the appeal of some policies. For instance, approvals for outbound investment linked to private equity funds in Hainan were suspended due to concerns that high net worth individuals might use them to move assets abroad. A report by The Wire in November 2024 highlighted similar issues. Alicia Garcia Herrero, chief economist for Asia at Natixis, noted that Hainan's main problem lies in its failure to deliver on promises of removing trade barriers. She said, "The problem with free trade zones, and especially Hainan, is that the promised lifting of barriers has not happened." There are a number of regulations that free trade zones should have been lifted, such as the negative list for investment and investment law and the opening of all sectors, but this is clearly not the case. Trump's campaign threats to impose a 60% tariff on all Chinese goods have further unsettled China's manufacturing sector, prompting businesses to accelerate their relocation to other countries. Exporters are also bracing for potential disruptions. American economist Xie Tian predicts that Trump's new policies, starting in 2025, would deliver a substantial blow to China's economy, with tariffs leading the charge. He believes this will cast a shadow over Hainan's future. Independent commentator Du Zheng remarked that Xi Jinping's vision for Hainan as a showcase for China's openness under an authoritarian system is likely to backfire. He described the project as a poorly timed initiative that coincides with Trump's return and renewed trade war threats. Du believes that the free trade port faces a high risk of becoming an abandoned project. Xi's recent visit to Hainan, where he pressed local officials to ensure smooth operations for customs closures, appears to reflect growing urgency. Du concluded, "Xi is clearly feeling the heat, and his trip signals both pressure and dissatisfaction with local efforts."